Hi, George. It's nice to see you. Well, with the FOMC meeting later this month, we wanted to discuss with you the potential implications of a change in U.S. monetary policy. The Fed has indicated that it's a time for change, and many investors believe that we are long overdue for a rate cut. So can you share your thoughts on this, and what is the potential damage of cutting rates too late?
As you said, Powell has signaled that he intends to normalize rates in an effort to engineer a soft landing. On the other hand, Bill Dudley and others have made it clear they think the Fed is behind the curve, and that potentially it may even be too late already to stop that negative feedback loop of rising unemployment, falling investment, and weakening consumer sentiment. And they may be right. I think in this case, the Fed probably had no choice. This cycle, we have seen higher core inflation and a more resilient real economy than we've seen in past inflation cycles. Reasons are debatable. One reason we think is probably the excessive fiscal accommodation that has supported demand throughout. But regardless of the reason, this Fed has made it clear that the risk of cutting too soon outweighs the risk of cutting too late. So if the skeptics are right, we can anticipate weakening economic data and potentially a recession in the coming months and quarters. But all this just underscores how difficult it is to micromanage the economy and fine-tune investor and market sentiment.
Absolutely. And how does all of this impact markets, and how does it impact our portfolios?
Yeah, it's a good question and very, very hard to answer. Obviously, in theory, falling rates should help risk assets. On the other hand, markets are anticipatory, and they are already pricing in significant easing. I think it makes sense to ask, why is the Fed cutting? Right now, the bond market's pricing in 100 basis points of easing by year end. If that's in response to a sharp rise in unemployment, it's very hard to see that being a positive for risk assets. In the portfolios, we continue to have a larger than average allocation to gold. Easing cycles tend to be a tailwind for gold, but also the structural allocation to gold as a hedge makes sense to us in light of the financial risks, the geopolitical risks, and also the fiscal imbalances that we see in the world today. In terms of opportunities, we've taken advantage of some of the strength in the tech sector to trim some risk in our exposure to the semiconductor value chain. And on the flip side, we still think the market is underpricing resilient businesses. And so we've opportunistically added to certain businesses in the consumer staples and healthcare sectors. As always in First Eagle, we are positioning the portfolios in such a way to be potentially resilient relative to the equity benchmarks if the macro backdrop deteriorates.
Well, thank you, George. As always, it was great to see you, and we look forward to talking to you soon.
Thank you, Christina.